If you're a beginner real estate investor, the lingo and the terms can be so confusing and make you scared and overwhelmed to start. I'm going to explain terms that you must know as a beginner. This way you can sound like you know what you're talking about, sound professional, and use that to make a lot of money. The first one is property. See, most people think of a property as just a single family home, but the term property can actually mean a bunch of different types of property. Like for example, this house. One family lives there, maybe it's a 4-bed, 2-bath, single family home. But there's actually way more than that. You can have a condo, which is basically an apartment in an apartment complex, or you can have a multifamily home, which has multiple apartments or units in one house. So for example, a house with 2 apartments in it would be known as a duplex. A house with 3 apartments in it would be known as a triplex. And a house with 4 apartments in it would be known as a quadplex. Anything more than 4 units is considered a commercial property. Now, the truth is there's not one type of property that's absolutely the best. Instead, different types of properties have different pros and cons than other types of properties. In the end, you want to choose the property that's most profitable. If that's the property that's a condo, then that's okay. If it's a triplex, then that's okay. Just pick the one that's most profitable. Now, usually when you buy a property, especially for beginners, you don't have too much money. If you're like most people in the United States, homes probably cost somewhere around $300,000 where you live. But when you're buying a house, you don't actually have to have all $300,000 that's involved in buying a property. You typically will go to the bank and get a loan. And a loan for a house is just called a mortgage. Some loans, like the VA loan for veterans or USDA loans in areas that are outside of cities, can allow you to get a house with as little as 0% down. But most people will have to put something down on other types of properties. For example, if you're going to buy an investment property, you need 20 to 25% down on a mortgage. That means if you're going to buy a $300,000 house, you will have to put about $60,000 down as your down payment. But this is amazing because you don't actually have to have all $300,000 in your pocket. Now that means right off of the bat, you have $60,000 in equity. What's equity, you ask? Equity is the difference between the value of the home and what you have left on your mortgage. Since the house is worth $300,000, but you have $240,000 left on your loan, that $60K is your equity. Equity's good. We want more equity. When I was starting out, I was so confused what equity meant, so let me give you a quick example that might help. Imagine underneath this house that you own, there's a treasure chest full of cash. The cash that's inside the treasure chest is your equity. But see, you don't have the key to open up the treasure chest. The only time you can get the key is when you're selling the house or when you do what's known as a cash out refinance or getting another loan on that property. So it's like you have money sitting in the house. More equity means more money and higher net worth for you. So now that you took a loan out on the house, you're gonna be paying the bank back every single month. They're gonna ask for some of the original money that you owed, the $240,000, plus some interest every month. That would be about $1,012 per month for your mortgage and interest payment. But when you get on the phone with the bank, they may say a term known as PITI or PITI. PITI is another term for the monthly payment that you will make to the mortgage company from your bank account every month. It stands for principal, interest, taxes, and insurance. Principal is the loan amount that you originally took out, the $240K. Interest is the profit that the bank will make on your loan. Taxes are the property tax you have to pay to the city every year. And insurance is the cost to protect the property in case if something goes wrong. So let's say your PITI on this property will be $1,500 every single month. That means every month you'll be paying $1,500 to the mortgage company. Some of that $1,500 will go to pay down the original $240,000 that you owe. Some of it will go to pay the interest that you owe the bank. Some of it will go for the taxes that you owe every single year, and some of it will go for the insurance. PITI is an expense to you as a rental property investor. It's something that you'll have to pay every month, but it's not the only expense. Usually you'll have to pay some of the utilities on the property, and you'll probably have to pay for property management. When you add all those up, let's say it costs $500 per month for both of those. That means your total cost for running the property would be $1,500 plus $500, which is $2,000 a month. But here's how real estate investing works. You're gonna take that house and rent it out to a family. Let's say houses of similar size and location rent for about $3,000 a month. Now you're gonna get a family to live in that house and rent it out for $3,000 a month. That means your income on the property will be $3,000 per month. But remember, the property costs you $2,000 a month for PITI, utilities, and property management. That means you'll be left with $1,000 in profit every single month. That is known as cash flow. cash flow is just the passive income you make from the rental property every single month, like that $1,000. Now, to get a really good idea of how much you'll make from your rental property, I did a complete breakdown of all of my properties and how much I make per month down to the cent. Click the video on screen to join me over there and watch that now.